Matt Smith is a lead analyst for the Americas at Kpler, joining us live this morning. Matt, it's great to have you on. So President Trump joining tech and energy executives amid this major push for AI. What was the key takeaway for you for the energy story?
Hi, Sherry. Well, really, it's the location, right? You have looking at those data centers in Pennsylvania there. That is where you have the Marcellus Shale, one of basically the leading shale play in the US there. You're also having a lot of data centers also being built in Texas, Louisiana, etc. Again, around those shale plays for natural gas. And so really this is a domestic production play, right? Natural gas in the US on Henry Hub is $3.50 an MMBTU there. So very low prices there. And so that's really what is driving on these projects, is the access to that cheap essential feedstock to go into to driving on the power for these data centers. You know, in terms of the US generation mix, is well over 40% in terms of natural gas across the US. Then you have the renewable piece coming in after that, you know, pushing up to around about a quarter of the power generation mix. So really, all of this is a story that's being driven by the success of the shale gas revolution.
Yeah, but if you look at the final version of the big, beautiful bill, you know, the likes of solar got sort of pushed out here, when a lot of analysts are saying that the U.S. will need both renewables as well as the fossil fuels to fuel all this demand, especially for AI data centers and so on. So how do you think about that, and what is really the pricing implications going forward from that?
Yeah, sure. And that's the thing. In the US, natural gas has always been looked as the bridge fuel to a renewable future, right? And it is still going to continue to be that bridge. It's a very essential piece of the generation mix. And so that will be leaned on heavily here. And so in terms of the pricing side of things, we have record LNG exports happening now, right? We've got different projects that have been coming online, taking that gas out of the US, and yet we're still looking at natural gas prices in the US at $3.50 there, and so very cheap. And so there is the ability here for enough supplies to be meeting the needs of these new data centers, whether it's in Pennsylvania, whether it's in Texas.
Hey, Matt, good to see you again. You're down in you're across in North Carolina, I know, but I mean up in PA, in Pennsylvania, we can't discount the fact that there could be political significance as well. This is a key swing state, and to me, this feels like, especially at $92 billion, this is campaigning already ahead of the midterms next year.
Yeah, exactly. But as we see with President Trump, right, he's all over the place. He's working on so many different things here. He's really obviously looking ahead to those midterms, but really he's looking at various different parts across the US, trying to get business going, whether it is AI or otherwise, bringing business back into the US. And so really this is just part of his bigger agenda as opposed to any kind of political move, I believe.
All right. So looking at energy, your call is you see oil in the 50s, mid 50s for the second half of this year. And we were talking about this offline a couple seconds ago. I asked you, look, PA, Pennsylvania, a lot of shale happening there. What is the cost, your estimate for them to take it out of the ground? And you were telling me about $60 a barrel. So at 50 or in the mid 50s, I mean, this is a non-starter. It's not going to incentivize them to shale rather to increase supply.
Well, Martin, we have a situation right now where prices are being very much supported. It is a seasonal thing. You know, that's why OPEC is being able to bring barrels back to the market here. You know, refining margins are strong. Refiners are running as hard as they can to meet summer demand. But our concern is that as we move into Q4 here, you have a culmination of different factors, not just from weaker demand, which is a seasonal thing, but also non-OPEC supply coming to the market, as well as all these slugs of monthly OPEC supply increases too. All this comes together at a time when economic data starts to get under the influence of all the uncertainty we've had relating to tariffs. that pushes prices down to that mid-50s level. To your point there, when you get to that sort of level on a WTI basis, that's when you start really testing those kind of smaller producers, testing their metal, whether they want to keep going. The one fortunate thing that has happened for them is that over the last month or so, because we saw oil prices kick that much higher, they were able to go in and layer in hedges. And so we should expect to see higher production out of them than perhaps we would have seen sort of 3 months ago coming into the end of this year here.
Oh dear. Okay, but then if this happens in an already oversupplied market with the prospect of growth and therefore demand slowing, that's it's not a great recipe for prices, right? Matt, I got to ask you.
Exactly.
I want to get a line from you on what the president is trying to do with Russia now. Not so much the tariffs on Russia itself. I mean, that's kind of insignificant because. What does Russia sell to the U.S.? Okay, uranium, fine. A lot of potash and fertilizer, which they can probably just as easily get from Canada. But the secondary sanctions, right, for countries that help Russia, all right, and I think there's the oil angle here, 100% on them, which would mean China, which would mean India, which both are heavy buyers, big buyers of heavily discounted Russian oil around sanctions, by the way.
Yeah, absolutely, Martin. And that's the real issue at play here, right? It seems that President Trump is loath to want to apply those secondary sanctions, not just because it is China and India, but simply because it would be taking oil supply out of the market here. When you look at those, the exports out of Russia, they're about 3.5 million barrels a day of crude, and 1.8 of that is going into India, 1.1 of that is going into China. And so these are those key markets there, and the Indians are benefiting hugely from this, right? It means that their refining margins are that much lower. And so we've seen with Iran, with President Trump there, even though he was really going after the nuclear facilities, he didn't want to have to take oil out of the market from Iran, because if that happened, that would cause oil prices to increase, which is the opposite of what he wants. It seems that he wants a $50 oil price here. He's not concerned about U.S. producers. He is focused on his base, and he is focused on prices at the pump, and he wants to keep that price down. And because of that, it seems that's why he's saying, there's a 50 days until we kind of maybe talk about these secondary sanctions, because he really just doesn't want to implement them.
Doesn't want to implement them. Okay, but in case he does, though, what options does China and India have in terms of energy, though, if not from Russia?
Well, with India, they get a lot of their supply from the Middle East, and so they'd have to turn there. But you're talking about replacing 1.8 million barrels a day into India. It's just not going to happen, right? Or it's not going to happen very easily. Prices are going to have to move. They're going to have to go out to the market to pay for that if that were to happen. So it just seems too big of an issue for that to happen, right? If that were to happen, prices would really kick higher. If we're talking about oil supply of 100 million barrels per day here, that's the 3.5% of that, right? So you really can't be taking that out of the market.
A lot of these countries are trying to lower their tariff levels. Negotiating with the Trump administration is talking about increasing natural gas imports, somewhat pressured, of course, by the U.S. as well. Do you think all of that has been priced into the price, has been priced into natural gas?
Yes, I believe so. Yeah. So we have a market for natural gas for those LNG exports out of the US, right, that are heading into Europe, that are heading into Asia. And so we have got the market for those. It's difficult for President Trump to be coming out and saying, Europe, you should be buying more. Europe is buying as much as it needs to, right? And so he can't really dictate to these countries for them to take more natural gas or more US oil, etc. He turned to China and was like, China, you should take more US crude. And that has stopped simply because of the tariffs. It's uneconomic. And so he may say these things, but it's another thing for these countries to actually play out with it. So in terms of the pricing dynamics here, barrels are flowing, those molecules are just moving.
Gotcha. Matt, listen, got to go. Great to talk. Appreciate the time. Great value as always. You keep safe and do it again very soon. Matt.